Okay, everyone, thanks for waiting. My name is Riley from CB Insights, and I'll be walking you through a few housekeeping items before turning it over to John for the presentation. First, don't worry about taking notes, as we'll be sending both the slides and the recording to you right after the webinar. Second, if you have any technical difficulties during the webinar, your best bet is to reach out to the Citrix Help Desk. You can also tweet at us or send an email to webinar@cbinsights, and we'll do our best to help. But again, we'll send everything out afterwards, so don't worry too much. Okay, so as with all of our webinars, we'll be moving through a lot of data and insights and doing it pretty quickly. We also want to make sure we're answering your questions and keeping this relevant. So throughout the webinar, feel free to ask us questions using the questions tab within GoToWebinar or via Twitter using the hashtag CBICannabis. So a little bit on CB Insights. We're a data science and machine learning organization backed by Pilot Growth Equity and the National Science Foundation. We track every private company in the world and all the investment and financing activity related to them to help our clients answer questions about major trends, competitor strategy, potential disruptors, and much more. Here you can see a few of our happy customers. So, a little bit about John. John is a research analyst here at CB Insights. He focuses on digital health, therapeutics, medical devices, and media. He previously attended medical school at Rutgers, New Jersey Medical School and is a graduate of Johns Hopkins University. I'm going to turn it off to him for the presentation.
Thank you for the introduction, Riley. And as she just mentioned, today we're going to be talking about one of the most feared and loved substances on the planet, cannabis. In the next 30 minutes I have with you, we're going to be speaking about macro trends enabling the transformation of the cannabis industry, as well as investment trends that will be broken down by sector and geography. And we'll be closing with a few words on how the industry is set to change in the years to come. To begin, we are defining the cannabis industry as companies operating in the business of selling marijuana, as well as companies whose primary target is the cannabis industry, such as online platforms for payments or compliance. One note here is that we're not going to be including companies focused on hemp and its industrial applications, such as in jewelry or fibers or paper. So let's jump right in. We're going to talk about macro trends and set the stage with a little bit of history. So marijuana was first outlawed, at least in the United States, in 1937, with the Marijuana Tax Act. This effectively banned its use and sale in the country. By the 1970s, however, this act was ruled unconstitutional and replaced with the Controlled Substances Act, which established the common scheduling system of drugs, which we're familiar with today. As we all know, cannabis was placed in Schedule 1 alongside cocaine and heroin. Now, while there have been significant doubts as to whether cannabis deserves this classification, it remains there today. Now, with this history in mind, it's a bit easier to understand why cannabis had such a low approval rating in the late 60s, at about 15%. However, time has passed and the public has become more familiar with the substance, and we're now seeing majority of the country in support of its legalization, most recently recorded at 60%. Now, this support has occasionally translated into law, as we're about to see. So, since 2012, more than 10 states have gone on to approve medicinal marijuana and 7 its recreational use. We are currently standing at 29 states approving medical marijuana and 9 recreational. Following a flat year in 2015, in which no new states ratified recreational or medicinal marijuana, 2016, which was a big election year, as we all know, saw 6 states approve its medicinal use and 4, including Massachusetts and California, its recreational. Now, these shifts in popular and legal opinion have, as we might expect, often translated into sales revenue. If we look at data from the cannabis-focused investor ArcView Partners, we see that sales in North America reached $6.7 billion in 2016. This is a 300% increase over 2013. Now, while the large majority of sales currently occur in the United States, Canada is also looking at legislation to legalize marijuana federally this year, so keep in mind that these figures could change. Depending on if the United States changes its position federally on legal marijuana, this might result in cannabis startups and investment firms moving their operations a little more north. According to data from the cannabis-focused investor ArcView Partners, sales in North America reached $6.7 billion in 2016. This was up over 300% since 2013. Now, while the large majority of sales occurred in the United States, Canada is looking at legislation to legalize marijuana federally this year, so these figures could change, depending on if the United States changes its position federally on legal marijuana. This might result in cannabis startups and investment firms moving their operations a little more north. So, as a result of increasing sales, public support, and legalization of cannabis, we've also been seeing startups attack the space from a number of different vantage points. In 2013, for example, equity investment into cannabis companies was based around about 9 different industries. 3 years later, in 2016, we are now seeing financial support for companies in more than 40, all operating around cannabis. We're seeing consulting services, inventory software, e-commerce platforms, compliance platforms, and many others being formed in order to fill pain points in the cannabis industry. In other words, we're witnessing an institution and all of the infrastructure it requires being built in real time. Here, we're able to see a little bit more visually what cannabis startups are being formed and what vertical they're operating under. We're now seeing everything from e-commerce platforms such as Ease Solutions in California, which delivers medicinal marijuana with the touch of a button, to accelerators like Canopy Boulder in Colorado, which invest in and provide guidance for companies working in the cannabis industry. All right, so let's now dive into the numbers and take a look at deals, dollars, and a couple active investors. Right here, we see that global equity funding since 2012 has totaled $560.7 million across over 270 deals. Looking at this on a yearly basis, we see that funding has actually decreased from 225 million in 2015 to 205 million in 2016. Total deals have also dropped down to 96 in 2016 from a high of 106 in 2015. This being said, over the last 4 years, we've seen 9 states, including New York, Florida, and Maryland, approve medicinal marijuana, and 7 its recreational use. This has led to global equity funding and deal flow skyrocketing since its lows in 2013. On a more quarterly level, and likely due to 7 states approving some form of marijuana late last year, Q4 16 saw a huge uptick in funding dollars, reaching $81 million across 25 deals. As a matter of fact, Q4 16 finished as the second strongest quarter since 2015, second only to Q1 15, which saw $94 million across 19 deals. If we take a look at exits within the cannabis industry, we see that they've generally trended up since 2012 and hit a high in 2014 with more than 30. 2016 saw 26 exits of cannabis companies, matching the previous year's total. As the financial upside of the industry has become more palpable for investors, we've seen that companies have been rushing to acquire startups working in this space, as the large majority of these exits have been via M&A. One example of a recent M&A deal is the July 2016 acquisition of the online legal marijuana marketplace, Cannabis. It was acquired by Helix TCS, which is a provider of operational solutions for the cannabis industry. Taking a look at the top exits, we notice 2 trends. First, 3 of the top 4 exits, including GW Pharmaceuticals, Zynerba Pharmaceuticals, and Canamed, are medicinal marijuana companies. This highlights the difficulty of startups working in recreational marijuana to enter public markets. And second, the market cap of any of the 3 medical marijuana companies far outweighs that of IIP, which is a real estate investment trust that plans to buy and lease buildings to growers of medical marijuana. And it was actually the first company to IPO on the New York Stock Exchange. One other trend I want to point out here is that non-medical marijuana companies are sometimes quick to IPO and receive low valuations because of it. This is typically done in the industry due to a need for capital and the difficulty of attracting outside investors. This trend actually runs in opposite to what we're currently seeing in the tech industry, where companies are actually waiting longer to go public due to widely available funding open to them on the private markets. Now, we should note here that these companies are the exception, not the rule, and that most marijuana stocks actually trade on over-the-counter exchanges, where penny stocks could be subject to sizable manipulation. Now, shifting gears for a bit, we're taking a look at a graph of global number of investors making first cannabis investment by year. And we see that the number of investors making their first investment in 2016 reached a high of 37. This was a 95% jump over the previous year. What this indicates to us is that investors are quickly realizing the potential upside of an investment in the cannabis industry and are looking to enter the space with increased frequency. If you look just at VCs that were included in the previous slides, we see that the number is growing every year. Institutional investors, such as hedge funds and venture capital firms, have long avoided the cannabis industry in light of federal law banning its use and sale. With that said, in 2016, we saw 10 VC firms make an investment in a cannabis company for the first time. And in 2015, we saw the first smart money VC, Founders Fund, take a plunge into the cannabis industry by joining Privateer Holdings' $75 million Series B round. Here at CB, we define smart money investors as top VCs based on portfolio strength and exit history. If we focus here on simply the most active investors in cannabis overall, we notice that the top investor is the Colorado-based accelerator and investment fund, Canopy Boulder. Canopy Boulder invests primarily in the legal cannabis industry in exchange for a 6 to 9.5 equity stake. In fact, most of the top investors here are cannabis-focused funds, which indicates to us a certain reluctance of more traditional funds and some of the larger VCs to make multiple investments in the industry. This results in cannabis startups being increasingly reliant on a few very industry-specific investors available to them and increasing their need to raise money on the public markets. Here we put together a social graph of the most active cannabis-focused investors. One observation is that they share a number of co-investments, including Work, AD Remedies, Tradiv, and have invested in each other, as we see with ArcView Group and Canopy Boulder. AD Remedies is a producer of gourmet cannabis edibles, and Tradiv is an online wholesale marketplace for licensed cannabis businesses. The company with the most co-investments is right in the middle, called Work. It's a software as a service HR platform designed to help cannabis businesses not only handle day-to-day HR operations, but to comply with the great many city, state, and nationwide regulations of the industry. Now, if we take a look at the largest deals to cannabis companies, we see Privateer Holdings, which is a Washington-based holding company and incubator, takes the top two spots. This is then followed by medicinal marijuana provider PharmaCannis. All of these rounds have been raised in the past 2 years, which indicates that investors may be more willing to take big bets on cannabis startups and that we may be seeing larger rounds in the years to come. Further, Seek Medical was funded by tobacco company Philip Morris this year, which marked tobacco's first foray into cannabis. If we focus on Privateer Holdings, Privateer is a Seattle, Washington-based holding company that acquires, invests, and incubates cannabis companies. Privateer struggled to pull together its Series A about 4 years ago, but in 2015, the number of states that legalized recreational marijuana more than doubled, and three more states, such as New York, had approved medicinal marijuana. This clearly paved the way for its larger $75 million Series B in 2015 and a $40 million convertible note just this past year. Privateer's path since being founded has often been a bit ahead of the more general investment community. For instance, when it was founded in 2010, 2 years before the first states would legalize recreational marijuana, and 6 years before the majority of the U.S. states would support medicinal marijuana. Now, part of what makes Privateer a special case is its ability to raise money from major VCs. Here we use the CB Insights Trends tool to analyze media mentions of Privateer Holdings since 2012. And we notice three clear spikes, all representative of funding rounds. The largest spike in the middle is media activity that occurred in 2015 and represents when Privateer raised its Series B from investors such as Founders Fund. Founders Fund is a San Francisco-based VC founded by Peter Thiel, Ken Howery, and Luke Nosek. In 2016, the firm raised 1.3 billion dollars for its sixth fund. Now, the reason this drew so much attention is because investors have historically been wary of investments in the marijuana sector in light of federal law prohibiting the recreational sale and use. So, Privateer's ability to raise implies Founders Fund not only saw enough financial upside for an investment, but opens the door for other major VCs to pay attention and possibly get involved themselves. So, why did Founders Fund invest? If you look at this snippet from Geoff Lewis, who's the partner at Founders Fund who led the deal into Privateer, he stated his confidence in the continued growth of the cannabis industry as the reason for their investment. So, let's now jump into corporate activity in the cannabis sector. Corporate participation in cannabis remains fairly limited, currently at about 5% of global deal share. Many of the corporates participating in deals already operate in the cannabis business themselves, such as Signal Bay or American Green. However, a few others have been willing to jump in for the first time. 2016 saw tobacco producer Philip Morris participate in a corporate minority deal to the Israeli startup Seek Medical. Seek Medical is a developer of a medical cannabis inhaler which enables enhanced dosing precision. Now, while it may make sense for tobacco producers to get involved with this industry, given the similar agricultural, manufacturing, and marketing requirements between tobacco and cannabis, Philip Morris remains the only tobacco producer with a disclosed investment into a cannabis company. So here I just want to highlight a point. Mr. Troy Dayton is the CEO of the ArcView Group, which invests in cannabis startups. He stated his dismay for the fact that cannabis has grown into a multi-billion-dollar industry, and yet it still has trouble attracting large investors and corporate interest. So let's now dive into exactly where deals are being made on a sector basis. Just to bring this graphic up again and to illustrate the point a little more visually, we're seeing everything from e-commerce platforms such as Ease Solutions in California, which delivers medicinal marijuana, to accelerators such as Canopy Boulder in Colorado, which invests in and provides guidance for companies working in the industry. Broken down by sector, we see that deals to cannabis startups in the healthcare sector represent over one-third of total deals to the industry. Internet companies such as Headset, which provide business and market intelligence for the cannabis industry, represent nearly 20% of deals, and agricultural companies come in third with 9%. Now, in healthcare specifically, we're seeing companies both working to develop marijuana as a treatment option and working to improve the delivery of those treatments. Two examples are PharmaCannis in Illinois, which provides medical marijuana, and Ease Solutions in San Francisco, which helps deliver it. Now, the need for these services is pretty clear, especially if we look at stats from New York. In New York alone, there are more than about 770 registered physicians in the medical marijuana program, and more than 11,000 patients in need of their services. So, if we dive into the internet sector for a second, we see that retail companies make up the majority of deals, followed by information service providers. Three companies targeting the retail sector are BioTrack THC, LeafLink, and MJ Freeway. The strict regulatory compliance requirements that basically all legal marijuana companies must adhere to has often paved the way for companies such as these to address this particular pain point. All three of these companies assist with inventory, sales, and compliance management, with Colorado-based MJ Freeway being the most well-funded at $8 million. So now we're going to jump into how deals are being distributed on both an international and national level. On an, international level, the US has commanded the large majority of global deal share to cannabis companies, currently at 84%, with Canada coming in second at 13%. As Canada looks at federal legalization this coming year, these figures could change significantly, especially if the US does not change its position on enforcement of federal marijuana laws. Within Canada itself, Deals are for the most part concentrated in Ontario, with British Columbia and Alberta rounding out the top three. Two of the larger deals coming out of Ontario this past year include a $12 million round to Green Organic Dutchman, which is a small batch producer of medical marijuana, and a $4 million round to Farmacielo, a supplier of naturally grown and processed medicinal cannabis oil. Now, within the United States, Colorado, where recreational marijuana has been legal since 2012 and medicinal since 2000, and California, where recreational was just approved but medicinal marijuana has been legal since 1996, have dominated deal share to the country. Two recent deals include a $15 million round to MedMen, which is based in Culver City, California, from Cat Meridian Ventures, and a $13 million round to Ease Solutions, which is based in San Francisco, from investors including Winklevoss Capital, yes, it's those Winklevoss twins, Tusk Ventures, and DCM Ventures. MedMen is a California-based management and advisory firm for the cannabis industry, while Ease Solutions is a developer of a medical marijuana delivery platform. So, in order to better illustrate where deals are going in the US, here we see a visualization of all disclosed first equity rounds to private companies. From 2011 to 2013, there were five disclosed first time equity rounds in cannabis companies. While the most deals occurred in Washington, California, Colorado, and New York were also early to produce cannabis startups. Now, jumping into 2014 through 2016, however, we see that the number of disclosed first equity rounds to private cannabis companies has basically exploded. Investor interest in the industry is widened enormously since 2013, and deals are being sourced from states such as New Mexico, Georgia, Washington, D.C., and Maryland, just to name a few. Washington and Colorado's legalization of recreational marijuana has certainly paved the way for a string of first equity rounds, while California, despite only changing its recreational laws in 2016, also saw a major upswing in equity rounds over the past few years. Despite recreational marijuana still being illegal in most states, companies are still finding ways to address the market. For instance, Ganja Boxes, which is a subscription based service for cannabis accessories and is based in New York, received $20,000 from the accelerator Canopy Boulder in 2015. And it's important to note that in New York, recreational marijuana is outlawed. So things are sure to change pretty quickly as the cannabis industry continues to mature. So let's now take a closer look at where some of the largest changes are going to come from. Here we've identified three sectors in which the cannabis industry will see major change in the next few years: healthcare, compliance, and payments and banking. We chose healthcare because the majority of US states now support its legalization, and we're continuing to see research into its use. Regulation will play an important role because as recreational and medicinal marijuana legalization spreads, cannabis companies will then have to focus on complying with a great number of city, state, and federal laws in place, not to mention interstate trafficking and adherence to tax laws. Innovation in payments and banking companies will play an important role in light of the fact that major banks currently refuse to operate with cannabis companies due to federal law resulting in many companies operating on an all cash basis. So, to begin with healthcare, President Obama has stated his support in classifying marijuana as a public health issue in much the same way that cigarettes or alcohol is regulated. To that effect, the Journal of the American Medical Association recently published a major paper on marijuana use in the United States in which they study the use of marijuana for medical purposes among adults in the US. Out of 96,100 participants with which they surveyed, 12,396 reported as marijuana users. Out of this total, 90% reported using recreationally and 10% medically. Now, what's interesting about those stats is that while the recreational market is approximately 9 times larger than the medical, we're still seeing investors focused on medical marijuana startups. The reason for this is likely due to federal and state regulations barring the sale and use of recreational marijuana, resulting in investors being unwilling to participate in such risky investments. However, as the regulatory framework evolves, we expect to see investors making the transition over to the recreational market. Now, as far as payments and banking are concerned, the large majority of cannabis companies, currently at 70%, do not have formal banking services, according to a report from the ArcView Group. What's even more interesting is that among ancillary service providers, meaning those that do not get involved directly with the production or sale of marijuana, but do assist, such as sales or e-commerce platforms, only half have a formal banking account. Now, the reason behind these stats resides in the fact that since marijuana is a controlled substance, banks such as Bank of America or Wells Fargo or Chase open themselves up to government seizure if they do business with the cannabis industry. This results in cannabis businesses often relying on small state chartered credit unions for banking services, of which there are few and far in between. While this trend is unlikely to change anytime soon, there are ongoing efforts to move the needle. Outside of the cannabis industry, there are proponents for the movement to allow cannabis businesses access to banking services without repercussions to the bank. Senator Elizabeth Warren, for instance, has been public with her support of a banking infrastructure for cannabis. However, time will tell whether widespread public support and the support of a few government officials will be enough to change the industry. Now, as we see here, while cannabis is illegal under federal law, states have made their own decisions. This has led to the US being a patchwork of cannabis being entirely legal in some states, being legal for medical use in others, and legal for medical and recreational use in the minority. Now, this is not to mention all the subtleties of the different state laws, which allows different amounts to be used in different places. Consequently, the US is currently a patchwork of federal and state regulations that both the business owner and the consumer must learn to comply with. Even if a cannabis store is in full compliance with state law, there's always the opportunity that the federal government can step in and close it down. As such, these companies operate in sort of a legal limbo, making compliance with state law of the utmost importance in order to lower the risk of federal prosecution. With that said, we are already seeing startups working to help businesses comply with a wealth of regulations around not only starting a cannabis business, but continuing to operate it. BioTrack THC operates in Florida, Colorado, and Washington, LeafLink in New York, and MJ Freeway in Colorado. Over the next few years, we will continue to see growth within the industry in terms of regulation, banking infrastructure, and healthcare research. While it may take more time for investors and corporates alike to become comfortable with a cannabis investment, there is no reason to believe entrepreneurs will be stopping anytime soon. So thank you all for listening, and we'll now be taking questions. Okay, so it seems we have a couple that have come up here from a number of different listeners. Um, okay, let's just take the first one. So the question is, what do you think will be the biggest obstacle for the marijuana industry going forward? Good question. Um, I would have to say regulation and compliance. The reason being that without federal law allowing the use and sale of recreational marijuana and permitting it in every state, banking services will still not be available to companies, and companies will still have to rely on raising capital from non-traditional investors or going to the few cannabis-focused funds that are out there. Um, Obviously, this holds back the cannabis industry tremendously. Um, so I would have to say that's probably the largest obstacle right now. Let's see, what else do we have? Okay, so This listener asked if marijuana is federally illegal. Um, how are so many able to go public? Good question, and that's probably a point I should have made a little more clear. Um, the companies going public are not necessarily in the business of producing or selling cannabis directly. The ones going public are actually ancillary businesses. As I explained previously, they're the ones that don't operate directly in the business but help it, such as any kind of online platform for payments or HR or even real estate trusts, or if you're leasing space to medical marijuana companies, things like that, that aren't actually involved in the illegal activity of selling recreational marijuana. And of course, medical marijuana companies could IPO. Um, okay, this is another really good question. Basically asking, do you think corporates are going to get more involved with cannabis? And if so, which? Well, I can't say which, but I would assume that as medical marijuana becomes more available throughout the country, right now we're at about 30 states, um, and the trend is just increasing. So eventually it will likely be all states in the U.S. You would have to assume that pharmaceutical companies such as your Johnson and Johnsons or your Mercks will have to get involved in this in research and possibly in the acquisition of pharmaceutical of medical marijuana companies. All right, I'll take one more. Let me see. Okay, this is a pretty good question. Do you think VCs are going to make more marijuana investments now that Founders Fund invested? Well, the actual question is, do you actually think VCs are going to make more marijuana investments? Uh, Good question. Um, well, I think Founders Fund took a very calculated risk, um, putting all that money into privateer. Obviously, there are enormous risks when making a cannabis investment, not to mention its federal illegality and each state having their own laws, which makes it very difficult to operate under. Um, so, do I think more VCs are going more? Let me take that question as meaning more major VCs, and the answer is yes. Um, Assuming that the privateer deal works out. If privateer ends up not as successful as Founders Fund is hoping for, I think that may be very negative. And I think other major VCs, such as Andreessen Horowitz's of the world or your Sequoias of the world, may see that very negatively and choose not to invest. Um, I think right now, maybe a lot of the major VCs are thinking the risks widely outweigh the potential benefit. And assuming federal legalization does pass at some point, at that point, I would probably you would probably start seeing all these major VCs jump into the area as the risks were greatly reduced. Um, so that's all the questions we'll take. Thank you all for listening, and the PowerPoint will be sent out to you. Thank you again.